For this session, we will talk about your financial assets. We will look into certain items of financial assets and discuss their recognition, their measurement, and their presentation. So in this particular session, we will not dwell regarding your standard itself, but we will dwell on your examples of financial assets. Before we go through and discuss the examples of financial assets, we start first with discussing a financial instrument. So, what is a financial instrument? A financial instrument gives rise to a financial asset of one entity and a financial liability or equity instrument of another entity. So, if we try to look on this particular uh, scenario, we have here your one entity which has a financial asset and another entity, the second entity, which has either your financial liability or equity instrument. This is a basic concept of your financial instrument because of the concept of your accounting equation, which we say if one entity has an asset, the other entity has either liability or equity. So, what is the liability of the other entity? We call it a financial liability. And what is the equity of another entity? We call that your equity instrument. Generally, your financial asset is likened to an investment. So when we say it is likened to an investment, if your another entity will issue bonds, bond payable is considered a liability. It is a financial liability. The financial asset on the portion of the another entity is known as investment in bonds. Next, if the second entity will issue shares of stocks, if the other entity will purchase the shares of stock, the financial asset is known as your investment in equity. Okay? So take note in a financial instrument, in this particular contract, there are two entities. Like any contractual obligation, which needs at least two entities, here your financial instrument has two entities. And what are those two entities? One entity with a financial asset and the other entity with a financial liability or equity instrument. One example is that, for example, the second entity will issue bonds payable. The counterpart on another entity, the financial asset is known as investment in bonds. Another example, if ever the another entity will issue shares of stocks to the other entity, we call that financial asset as investment in equity. Take note of the conjunction used. It is financial liability or equity instrument, financial liability, or equity instrument. So are there cases in which we have both financial liability and equity instrument? So instead of the conjunction or, our conjunction now is and. So are there cases wherein we have a conjunction and? Yes, there is a case. What do we call that type of instrument? So we call that instrument as compound financial instrument. Okay? So guys, if it's purely financial liability plus financial asset, so the combination is either financial asset plus financial liability or financial asset plus equity instrument. But what if we have financial asset plus financial liability and equity instrument? What do we call that one? We call it as compound financial instrument. Okay. Having now an idea on what is a financial instrument, let's take a look and dwell on what is a financial asset, what is a financial liability, and what is an equity instrument. So let's define now a financial asset. So what is a financial asset? Financial asset, the definition provided by this standard, which is PFRS 9, it provides you an enumeration. So the definition here is more on enumeration type rather than a exact definition, just like your financial instrument a while back. So in our standard, it provides for this enumeration of financial assets. It is considered a financial asset if it is a cash. Another, it is considered as a financial asset if you have a contractual right to receive cash or another financial asset from another entity, or to exchange financial assets or financial liabilities that are potentially favorable. Take note of the keyword potentially favorable. Why is it potentially favorable? Because we need economic resources or we need economic benefits. Then, if we need economic resources and economic benefits, we should look into inflow. When we look into inflow, these are favorable events. So take note of the words used in this particular definition: a contractual right, which is potentially favorable. This cash, I have no problem with this. You have already encountered it in AE 100, but later we will discuss how to measure it. Next, contractual right. What is this contractual right? You know this one in layman's term as your different receivables. Okay, so these are your different receivables. Examples are accounts receivable, notes receivables, any receivables, so long as you have the right to receive cash or another financial asset. And third one, the equity instrument of another entity. What do we call this equity instrument of another entity? We call this one your investment in equity securities. Okay, so again, your financial assets PFRS 9 provides for an enumeration as to the definition of a financial asset. And what are those? First, cash. Second, we have your receivables, which is a contractual right. Third, an equity instrument of another entity, which is your investment in equity securities. We go now and define financial liability and equity instrument. So what is a financial liability and equity instrument? So a financial liability, if ever the other financial asset, if you still remember, just finish it, it is a contractual right. In a financial liability, it is defined as a contractual obligation to deliver cash. So in financial asset and financial liability, financial asset, what is given is receive cash, so right to receive. In financial liability, this is an obligation to deliver cash. Another definition, it is to exchange assets and liabilities that are potentially unfavorable. So in financial asset, the definition provided is potentially favorable, but in financial liability, the definition provided is potentially unfavorable. Why is it potentially unfavorable? It is potentially unfavorable because take note, this is an obligation. If you have an obligation, your economic resources will decrease or your economic benefits will decrease. Because of decrease, this is considered an outflow. Outflow is unfavorable. Inflow is favorable. So in a financial liability, take note of the words used: contractual obligation to deliver cash. And then exchange, which is potentially unfavorable. A while back, in your financial asset, we have the right to receive cash, and exchange, which is potentially favorable. Let's go now and define what is an equity instrument. An equity instrument is any contract that evidences a residual interest in the assets of an entity. Take note, in an equity instrument, what happens? We have here an asset and we have here an equity. You remember the definition of an equity per your conceptual framework. This is your residual interest. Therefore, when we talk about your asset, this gives you the right over the residual interest. So when we call this particular instrument itself, it is called a contract, which now evidences your right over the residual interest on one entity. Okay? Take note, in an equity instrument, what happens? There is an asset on the other portion and there is an equity. On your asset, you have your right over the residual interest. In the equity, of course, that is your residual interest as defined by your conceptual framework. So when we talk about your equity instrument per se, this is now considered as a contract which now evidences the residual interest. Okay? So take note, financial instrument, what did we learn? It creates a financial asset on one entity and a financial liability or equity instrument on another entity. Now, if ever it is financial asset plus financial liability and equity instrument, we call this one as your compound financial instrument. And how do we define a financial asset? We define your financial asset by giving the different examples or enumeration of your financial assets, such as your cash, your receivables, and your equity investments. Next, your financial liability. This creates an obligation to deliver cash or to exchange, which is potentially unfavorable. And lastly, we have your equity instrument, which now evidences a residual interest. Having now defined what is a financial instrument, a financial asset, a liability, and equity instrument, let's dive into the different financial assets that we will discuss today. So the following financial assets will be discussed this session. First, it's your cash, and then we go with your cash equivalents, and we go with your receivables. Let's start first with your cash. So what is cash? Cash, it includes money and any other negotiable instrument that is payable in money and acceptable by the bank for deposit and immediate credit. Okay, so there are two items of cash. So what are those two items? First, it is money. Second, it is a negotiable instrument. But take note of the last phrase of your definition. It must be acceptable by the bank for deposit and immediate credit. Sir, what do we mean by acceptable by the bank for deposit and immediate credit? It must be readily available for use. So what do we mean by readily available for use? When we talk about your cash that is readily available for use, we look whether it is restricted or unrestricted. Okay. If it's restricted, of course, it is not readily available. When we say restricted, of course, you cannot make use of it. Therefore, it is not readily available. How about if it's unrestricted? When can we say it is readily available for use? We say it is readily available for use if it is for current use. If it's for current use. But if it's for non-current use, then it is not considered readily available. So not readily available. So when can we say it is readily available? When it is unrestricted for current use. Later, you will understand why we need to say that it is unrestricted for current use. To take note, cash, you have only two items, money and negotiable instrument. What we need to learn later is what are the items of money and what are the items of negotiable instrument. So let's start with the items of your money and negotiable instrument. So the following are the items of your money and your negotiable instrument. We start first with your money. So money contains these three items. So we look into these three items and determine whether it will be part of cash or not. So in your money, we have your cash on hand, cash in bank, and your cash funds. So what is a cash on hand? Of course, that is your cash on hand. So whatever is your cash that you currently hold in your business enterprise, that is your cash on hand. Cash in bank is your money deposited in the bank. Cash in bank is the money deposited in the bank, and your cash funds is known as your cash set aside for a particular purpose. Okay, cash on hand. So it is a money on hand, cash in bank, money deposited in bank, cash funds, cash set aside for a particular purpose. Now, for your cash on hand, cash in bank, and cash funds, we have these measurement principles. So how do we measure them? If ever the money is a foreign currency, so what do we mean by a money not a foreign currency? When the money is not in foreign currency, we mean that the money is considered to be not denominated in Philippine peso. If the money is in foreign currency, we consider it as not denominated in Philippine peso. But if the money is in local currency, we mean that that this money is denominated in Philippine peso. Let's start first on the measurement of a foreign currency. So if you have a foreign currency, then you should measure it at current exchange rate. So for example, you have $5,000 and the current exchange rate is equal to $1 is to 50 pesos. You should measure it based on the current exchange rate. This 50 pesos. So 5,000 times 50. So we have here 250,000 pesos. That is for money considered as a foreign currency. How about a money that is considered a local currency? We measure it at face amount. So if the money is 50,000, you should measure it at the amount itself at its face 50,000. So take note, in a foreign currency, you get the current exchange rate. So just multiply the foreign currency to the current exchange rate. But the question is, when will you get the current exchange rate? You will get the current exchange rate every balance sheet date. Okay? Every balance sheet date. When we talk about balance sheet date, that is the date of preparation of your financial statements. So, for example, you have here $5,000. Your balance sheet date is December 31. So, the following exchange rates are given. So, November 1, $1 is to 48. December 1, $1 is to 49. And then December 31, $1 is to 51. December January 30. January 31, $1 is to 52. Okay. So if we have a foreign currency, which is now 5,000, when do we measure it? At its current exchange rate. The current exchange rate is measured at balance sheet date. So what is our balance sheet date? December 31. So look at the exchange rate on December 31. That is the amount of our measurement of your foreign currency. Okay, again, for your money, how do we measure it? If it's foreign currency, we use the current exchange rate. The question is, what current exchange rate? When do we translate it to your current exchange rate? We translate it at the balance sheet date. Now, what if it's local currency? Whatever is the face amount of the currency, that is our measurement. So in our example, if the face amount is 50,000, then we will measure it at 50,000 pesos. Now, after talking about your different measurement, we talk now on your certain issues under your cash on hand, cash in bank, and cash fund. In your cash on hand, generally, whatever is your cash that you held in your business or that you currently hold in your business is considered cash on hand. No problem with this. More problems are confronted as to your cash in bank. So what are the items that we need to discuss in your cash in bank? First is your bank overdraft. What is this bank overdraft? When the balance of the bank account is negative. When the balance of the bank account is negative, then we can say it is bank overdrawn. So when we say bank overdrawn, from the word itself, you drawn much than your deposits. So for example, you have your deposits of 30,000. And these are your different drawings. Drawings, let's say 32,000. So out of your deposit, 30,000, you drew 32,000. So what is the effect? You have negative 2,000 because you have overdrawn, overdraft or overdrawn. Since you overdrawn, we call it bank overdraft. The question is, what is the treatment of a bank overdraft? For a bank overdraft, take note of this. A bank overdraft should always be presented as a current liability. Bank overdraft, general rule, we have a current liability. Why, sir? Because instead of receiving something due to your deposit, you will pay more because of your overdraft. It's overdraft because you have more draft or drawings rather than your deposit. So this negative 2,000 will be presented as a current liability. Remember, bank overdraft, current liability. So what is the exception to that rule? If ever, guys, that particular that particular bank is bank overdraft is considered immaterial, or when you maintain two or more accounts on that bank. Okay, so if it's immaterial or two or more accounts, you net it. You net it. So for example, cash in bank, BPI, 300,000. Cash in bank, PNB, 2,000 pesos. So how much is your cash and cash equivalent? Okay. Of course, this 300,000 cash in bank PPI is of course cash. But what is this negative 2,000? This negative 2,000 is considered a bank overdraft. And how do we treat this bank overdraft? This bank overdraft is considered as a current liability. The exception to that rule if it is immaterial. So for example, the problem provides that it is considered immaterial. If the problem provides that it is considered immaterial, then you can net it. Sabi natin, general rule, current liability. Exception to the rule, if it's immaterial or two or more accounts, you net it. So if it's immaterial, what is the net cash? 300 less 2,000, 298,000. So our answer will be 298,000. Again, as a rule, if ever it is only bank overdraft, it is current liability. So the 2,000 is a current liability. But what if it is provided that it is immaterial? You can net it. So we will net it 300 less 2,000. The net amount is 298,000. So that is an example of your immaterial. How about your example of two or more accounts? So for example, cash in bank, BPI, 300,000 pesos. Cash in bank, PNB. So let's say checking account, negative 10,000. So this is a bank overdraft. And then we have here another cash in bank, PNB, savings account, 20,000 pesos. Okay. So we are already done as to your immaterial. Let's have an example of two or more accounts. What did we say? If it's two or more accounts, you present it at net. So since you have here two or more accounts on the same bank, two or more accounts on the same bank, we can net it. Because this is PNB and this is PNB, you can net this one, 10,000. So net cash, 310,000. Okay. First issue in your cash and bank that we will discuss, we call it your bank overdraft. As a rule, bank overdraft happens when the balance of the bank account is negative. Why is it negative? Because the drawings is greater than your deposit. Since it is now negative, how should we present it? We present it as part of your current liability. The exception to that rule is that if ever it is immaterial, so what will happen if it's immaterial? You net it. And another exemption, if you have two or more accounts on the same bank, then you can net it. So in our example, we have your PNB and PNB, same bank, you can net it. Okay? So that is your bank overdraft. Take note that if there's bank overdraft, we follow this rule. Current liability, or we net it if ever it is immaterial or there are two or more accounts. We go now to another issue, which is your compensating balance. So what is a compensating balance? So normally in a deposit in your cash in bank, you leave a certain amount which you cannot make use of, or that is the minimum balance that you will maintain on that particular account. So normally in banking practice, this is applicable, wherein you should retain a minimum balance, which is called as your compensating balance on that account. So how do we treat your compensating balance? Okay, if ever your compensating balance is unrestricted, it is considered cash. If ever it is restricted and for short term, it is considered cash. If it's for long term, it is considered non-current. So for compensating balance, if it's unrestricted, it is considered cash. If it's restricted, but for short term, so meaning it is a compensating balance for a short-term loan. So normally, guys, if you get a loan from a bank, you need to leave a certain amount on that bank account. And that certain amount is considered as compensating balance. If the loan is short-term, we consider it as cash held as compensating balance. But if it's considered long-term, it is non-current. So this is cash held as compensating balance. Okay, so this now goes with your current and your non-current. Remember, we said initially, right? When we talk about your restrictions, if it's restricted, we don't normally say it is not part of cash. We look whether it is for current purposes or for non-current purposes. If it's for current purposes, such as short term, it's still cash. If it's for non-current purposes, then it is considered long term, then not cash. Okay? So we go back on our first discussion a while back. We have discussed that if ever in your readily available for use, we talk of unrestricted cash and restricted cash. Unrestricted cash is always cash. In your restricted cash, we need to look if it's ever short term or long term. If short term or current, it can be considered as cash. If it's long term or non current, it is considered as not cash. Okay. So we're done. Bank overdraft, compensating balance. We go now to another issue in your cash in bank. What is that issue? Closed bank. So what happened in a closed bank? If there is a closed bank, of course, you cannot already get your deposits out of that closed bank. Okay? So since it is already closed, you cannot already get the deposits. So what will happen if ever it is a closed bank? Guys, if that is a closed bank, our treatment is that closed bank. The treatment is we will not account for it as cash. It will be presented as a receivable. It will be presented as a receivable at its realizable value. Okay, take note. If you have a cash in bank, closed bank, how do we treat it? Receivable at realizable value. Receivable at realizable value. Okay, so let's review your different issues as to your cash. So what are the issues as to your cash in bank? So the first issue that we have discussed is your bank overdraft. General rule, this is considered as a current liability, therefore not cash. Exception to the rule, meaning we net it to cash balance. What are those exceptions to the rule? First, if ever, the bank overdraft is immaterial. The second one, if ever we have same bank, two or more accounts. Okay? Bank overdraft, general rule, current liability, therefore not cash. Exception, we can net it to cash balance if ever it is immaterial and to a same bank. Next, we have your compensating balance. Your compensating balance, if ever it is unrestricted, considered cash. If it is restricted, but for short-term purposes, it is considered cash. If it is restricted for long-term purposes, it is considered not cash. It is considered a non-current asset. Okay? And then last issue in your cash in bank, you have your closed bank. What is our treatment on your closed bank? It is considered a receivable, not cash. How do we report it? At its realizable value. Sir, what do we mean by realizable value? This is the amount that you can receive, you will receive out of your deposits. So for example, your deposits is 500 million pesos. So whatever is the realizable amount that you can collect out of that is considered realizable value. So for example, 500 million, you can only collect, let's say, 389 million. So the 389 million is considered your realizable value. Okay? Issues in your cash in bank, bank overdraft, compensating balance, and your closed bank. So I hope we are clear on these items. We go now to our third item of our money. So what is the third item of our money? The third item under your money is considered as a cash fund. So what is a cash fund? A cash fund is a cash set aside for a particular purpose. So you look into the purpose. If the purpose is for current or short term, it is considered cash. Okay? If it's current or short term, cash. But if it's for non-current or long term, it is considered not cash. Non-current asset siya. Okay. Cash fund, you look into the purpose. If the purpose of the fund is current or short term, cash. If the purpose of the fund is non-current or long term, it is considered not cash, a non-current asset. So let's have some examples. Petty cash fund. So what is a petty cash fund? A petty cash fund is a cash fund set aside for small expenses. So from the term itself, petty cash, petty means it's small, so it's small cash fund. It is for small expenses. Since it is for expenses, normally expenses are current. Okay, so diba, we look into the purpose. The purpose is for expenses, which is current. So if it's current, cash or non-cash, it is considered cash. Another, payroll fund. Payroll fund. Payroll fund. Payroll is normally a current liability. So you pay your wages always. So it is a current liability. Since it is considered current, question, cash, not cash, we say it is cash. Take note for cash funds, you test the purpose, if it's current or non-current. So in this case, the purpose is current, so cash. Next, PPE retirement fund. PPE retirement is the purpose. PPE question. Current, non-current. It is considered non-current. Therefore, this is not cash. Another, we have your bond sinking fund. Normally, bond sinking fund is for your bonds payable, in payment of your bonds. Bonds payable, current, non-current. Normally, bonds are non-current, therefore, it is not considered cash. Okay, so we go back. In your cash fund, this is a cash set aside for a particular purpose. So to properly account for it as part of cash or not part of cash, you need to look as to the purpose. So if the purpose is for current or short term, it is considered cash. But if the purpose is non-current or long term, it is considered not cash or non-current asset. Next, we have your negotiable instrument. So what is this negotiable instrument? So when we talk about your negotiable instrument, take note, sabi natin sa cash, it is considered money or negotiable instrument, but it must be readily available for use. So in your negotiable instrument that is readily available for use, we are talking about your checks. We are talking about your checks. So your checks, we have here your unreleased check, your post-dated check, and your stale check. So first, we have your unreleased check. So what is an unreleased check? So I hope you already know what is a check or you have seen already a check. So once you have a check, let's say you have already signed it. So this is the check. Let's say this is the date, the amount, and then in words, and then your signature. Okay. So that is already your check. If this check is not given to the payee, okay. Sir, who is the payee? The payee is the person named in this particular check. So whatever is the payee, if we did not give that check to the payee, then it's considered unreleased check. For example, I will draw a check. When I see I'll draw a check, I will write a check. So the payee is Juan de la Cruz. If I did not give the check to Juan de la Cruz, it is considered unreleased check. So what is an unreleased check? The treatment of an unreleased check is it is part of cash. Unreleased check, part of cash. Another type of check is a post-dated check. So in a post-dated check, you need to know if you are the issuer or the receiver. So meaning when you issue post-dated check or you receive a post-dated check. So what is a post-dated check? This is a check that is dated on a later date. So for example, today is February 18. Today is February 18. When we say it is post-dated, let's say I dated it February 23. I dated it February 23. So that is a post-dated check. I issued a check today, February 18, but the date of the check is February 23. We call that a post-dated check. So check that is dated on a later date at the date of its issuance. February 18, date of issuance. And February 23 is the date of the check. We call that post-dated check. So in a post-dated check, you need to look whether it is a check by the issuer or by the receiver. So when we say check by the issuer, so for example, J. Tamayao will issue, I'm the issuer, so I'm the issuer. I will issue a check which is post-dated to Juan de la Cruz. Okay? I will issue a check to Juan de la Cruz, which is post-dated. So the issuer here is J. Tamayao, and the receiver is Juan de la Cruz. So if you are the issuer of a post-dated check, this is considered cash. So it is part of cash. Post-dated check on the part of issuer, part of cash. While post-dated check on the part of the receiver is considered not part of cash. Okay? Post-dated check, this is a check that is dated on a later date. On the part of the issuer, if you issue it, it is part of cash. Sir, why is it still considered part of cash? I already issued the check. Because take note, you issue it on February 18, but it will only transfer on February 23. So in short, as of February 18, at the time you issue the post-dated check, it is still part of your cash. When is it? When is the time that it will transfer to Juan de la Cruz? February 23. So as of now, it's still part of cash. So on the part of the receiver, since you will only receive that as cash really on February 23, then as of today, which is February 18, it is considered not part of cash. Okay? Post-dated check, if on the part of issuer, cash. On the part of the receiver, not part of cash. Next is stale check. A stale check is considered an expired check. So when we say expired check, this is a check issued 6 months already, 6 months outstanding. Okay? So it is a check issued 6 months outstanding. So in short, within 6 months, let's say February 18, within 6 months, you did not encash. Okay? So if today you receive a check, if within 6 months you did not encash, we consider that check as a stale check. Okay. On the part of issuer of the check, that stale check will be part of cash. But on the part of the receiver, it is not considered not part of, it is considered not part of cash. Okay? So stale check, this is a stale check. It is considered expired check, meaning it is already outstanding for 6 months. If it's outstanding for 6 months, what do? We don't place it as part of cash on the part of your receiver. On the part of your issuer, it is considered cash. Okay. So on your checks, what are the issues? Unreleased check, we say this is part of cash. Post-dated check, it depends if you are the issuer or receiver. Issuer, part of cash. Receiver, not part of cash. Still check, on the part of issuer, part of cash. Receiver, not part of cash. So those are the different issues and guidelines on your cash. So your cash, take note, it is only money or negotiable instrument that is readily available for use. And we discuss the different issues as your cash on hand, cash in bank, cash funds, and your negotiable instruments. Please do not forget the measurement basis of your cash. Next, we proceed now to a cash equivalent. So what is a cash equivalent? So in your cash equivalent, these are short-term, highly liquid investments that are readily convertible into cash and so near their maturity that they present insignificant risk of changes in value of your interest rates. So the definition of your cash equivalent is provided by PAS 7, which is your statement of cash flows. Take note, they are short-term and highly liquid investments. So when we talk about your investments, we have two. We have your equity investments and we have your debt investments. We have already said that a while back in our introduction. So take note, it must be short-term and highly liquid. When we say it is short-term and highly liquid, it must bear a due date. It must bear a due date. A debt instrument bears a due date. An equity instrument does not bear a due date. Take note, an equity instrument does not bear a due date, but a debt instrument bears a due date. Therefore, debt instruments are tested if it is a cash equivalent, while equity investment is not tested. Okay? But there is an exception to your equity investment. That is your redeemable preference share. Okay, now guys, take note here of the terms short-term and highly liquid. When we talk about short-term and highly liquid, one thing that we look is the due date. Therefore, when can we say it is highly liquid? It is considered highly liquid if it is purchased 3 months before maturity. Okay? Purchase 3 months before maturity. So therefore, a cash equivalent actually is considered a debt instrument and a redeemable preference share purchase 3 months of before maturity. So some examples of this is your treasury bills. So let's say it is a 90-day treasury bills. 90-day, pasok ba sa 3 months? Yes. How about 120-day? Pasok ba sa 3 months? No. If pasok sa 3 months, it is considered cash equivalent. If hindi siya pasok sa 3 months, it is not considered as cash equivalent. Are we clear? Another, if you purchase equity shares, okay, sabi doon, equity shares. Question, cash equivalent? Not cash equivalent. Not cash equivalent. Why? We said an equity investment, which is an equity share, is not tested because it does not have due date, unless that is a redeemable preference share. Okay, so example, redeemable preference share, sabi. Tapos 120-day, cash equivalent, not cash equivalent. What is our rule? Our rule is that debt instrument and redeemable preference share purchased 3 months before maturity. So we have your redeemable preference share, 120-day. Question, 120-day, 3 months or not? Not 3 months, therefore not cash equivalent. But what is placed here is 60-day, it is within 3 months, therefore it is considered cash equivalent. Okay, so what I want you to remember on a cash equivalent is the definition. And aside from that, the items. What are the items? Only your debt instruments and redeemable preference share. If it is not a redeemable preference share but equity instrument, what did we say? If equity instrument, not cash equivalent. What is the only equity instrument that is cash equivalent? That is your redeemable preference share. And take note of the key period. The key period here is it must be purchased 3 months before maturity. Here, where did we get 3 months? 3 months make it highly liquid. And also, that is the maturity date in which there is insignificant risk of changes. So within 3 months, it is presumed that there is not much of a risk as to the changes of value. So that's why we use the 3 months rule. So that instrument and redeemable preference share purchased 3 months before maturity. Cash equivalent. Okay? So yun yung mga kailangan yung tandaan dito. Debt instrument and redeemable preference share, 3 months. We go now to another financial asset. That is your receivable. As I said, a receivable is a contractual right to receive cash or any other financial asset. Your receivables can either be trade or non-trade. So when we talk about your trade receivables, these arise from the sale of goods or services in the ordinary course of business. When we talk about non-trade, these are receivables arising from other sources that are non-trade receivable. So on your trade, isa lang siya. If ever it is sale of goods or services in the ordinary course of business. When it's non-trade, it arises not from trade. Not from trade. Take note of that. Trade, sale of goods or services in ordinary course. Non-trade, not from trade, meaning not from sale of services or sale of goods. So what are some examples of non-trade? So advances to officers and employees. Why? You have a receivable here to your officers and employees. Officers and employees is not from sale of goods or services, therefore non-trade. Next, advances to subsidiaries. You already know what is a subsidiary based on your consolidation. We have discussed in your conceptual framework. When you have advances to subsidiaries, meaning this is not again a sale of goods or services. So you have a receivable but not due to sale of goods or services, therefore non-trade. Another, deposits for potential damage or losses. So these are again receivables, however, not arising from sale of goods or services, non-trade. Next, deposits paid as guarantee for performance or payment. Another one, which does not arise on your sale of goods or services, non-trade. Dividends receivable, interest receivable. This does not come from sale of goods or services, therefore, non-trade. Any claims, so long as you have a claim, but not coming from sale of goods or services, non-trade. What I want you to always put in your mind here, if it's trade, it is coming from your sale of goods or services. If it's non-trade, it is coming from not sale of goods or services. So if it's sale of goods or services, trade. If you have a receivable out of that, trade. If not, then it is considered non-trade. Keep that in your mind as to the classification of your receivables. So trade or non-trade. Now, how do we measure it? To measure your receivables, initially, it is fair value plus transaction cost. Fair value plus transaction cost. The subsequent measurement is your net realizable value. Soon you will learn net realizable of value of AR is different, notes receivable is different, and loans receivable is different. But you will learn this one in IA1. But generally, it is your net realizable value or your amortized cost. Amortized cost. Okay. So measurement of receivables, fair value plus transaction cost. Subsequently, net realizable value or amortized cost. Presentation of receivables. So how do we present your receivables? If it's trade, take note, it is current asset when they are expected to be realized within the normal operating cycle or 1 year, whichever is longer. Do you still remember this one? This is defined under past one regarding your current and non-current. And we have already discussed that, right? So for example, if you are a what do we call this one? Construction company. If you are a construction company, generally your operating cycle is more than 1 year. So even if it's more than 1 year, if ever you have a receivable coming from that construction, which is your normal operating cycle, it is still considered current. Okay? So I hope you still remember the difference between a normal operating cycle and 1 year. Take note of the keyword longer. Take note of the keyword longer. Okay. Now, how about your non-trade? How do we present it? It is considered current if it is collectible within 1 year. Current if within 1 year. This is with regard to past one. If not collectible within 1 year, so it is more than 1 year, then it is considered non-current. Okay, again, receivables, we look whether it is trade or non-trade. Trade arising from goods or services. Non-trade not arising from sale of goods or services in the ordinary course of business. How do we measure them? Initially, we measure them at fair value plus transaction cost. Subsequently, we measure them at your amortized cost. And how do we present them? Trade always current, and take note whichever is longer under your normal operating cycle or 1 year. In your non-trade, it will be current if it is within 1 year. Otherwise, if it's more than 1 year, non-current. So that's it for our financial assets. We discuss cash, cash equivalents, and your receivables.